Good morning, everyone, and welcome to the Proficient Investor Series. My name is Suja Sham of Lux Capital Investment Group, and I'm here with Fatima Carter of Arbor Financial Group. And today we're really excited to dive into the basics of investing in real estate, including your goals and how you can get started with the equity that you already own. So we are really stoked to dive into it, and we'll just start with a brief intro. So Fatima, would you mind introducing yourself?
Hi, everybody. My name is Fatima Carter, and I am with Arbor Financial Group based out of Santa Ana, California, but I do live in the Pacific Northwest in Oregon. I am licensed in California, Oregon, Idaho, Washington, and I have colleagues that are licensed in various states that I can still help with. I have been a real estate investor since 2005, and I've been a mortgage loan originator since 2002. So I've been in the business for a long time in both the real estate industry and the lending industry. So I feel pretty well versed, been through the boom and the bust and then the boom and then, this interesting time right now. So thank you all for joining us. I'm excited to get to know you guys.
Awesome. So everyone, my name is Suja Sham, and I am the CEO and founder of Lux Capital Investment Group. I have been in real estate since 2010. That's when I graduated from business school and started actually by flipping a house. And believe it or not, I was one of those people that started with no money. So I literally used my student loans to start investing in real estate. And that was just the beginning of how I moved forward in that space. And so the next thing I did was work for large financial institutions, and I helped them underwrite and analyze large multifamily transactions. So I have that institutional background. And at some point, I decided that the corporate world wasn't for me. I wanted to be an entrepreneur. And so I started building my own real estate portfolio. And I did that, and I replaced my corporate income through Airbnb. And then I wanted to diversify my investments. And so I started Lux Capital Investment Group, which is designed to help people invest in real estate who are busy professionals and don't want to be a landlord and don't want to be hands-on investors, although it does pair well with people who do own rentals. So I'm really excited to be here today, passionate about educating people, passionate about helping you learn how to grow your wealth through real estate in a really powerful way. And of course, that all translates into having the life that you want. And that's what really matters. So, all right, let's dive into it. So why is it important to invest? So when you think about investing goals, the very first thing that is important to think about is your goals. Okay, so common goals that people have when they're thinking about investing: secure retirement, right? You want to make sure you don't run out of money. You want to make sure that you're secure and happy and safe in your retirement as far as your finances go. A lot of people want to pay for kids' college. It's a huge expense that a lot of people feel the need to start planning for, and really should start planning for very early on. Of course, in those early years of raising kids, there's a lot to think about, a lot on your plate. It's a heavy lift, and investing isn't always top of mind, but it is so powerful if you can get started early. Work less, stop trading time for money. A lot of people get into real estate investing because they want more control over their time. They want more control over their schedule. They don't want to grind away. They're getting burnt out. That kind of dovetails with career change, right? If you're getting tired of your career and you want to switch careers, can you withstand a decrease in your income? So investing in real estate can help bolster your cash flow. It can create a cash flowing portfolio, which allows you to rely less on your job and give you some breathing room so that you can change careers and build passive income. So that also is part of why people invest in real estate, is because they want to have cash flow that doesn't come from their job, right? It's kind of goes in hand with trading time for money. If you can have streams of passive income, then you're more freed up to do what you want with your time. So how do I sum this up? For me, it all is about optionality and peace of mind. I don't like being told what to do, frankly, and I really want to be able to make choices about my life and decide how I'm going to spend my time. And the other thing is I want to feel secure. So investing in real estate really gives me a lot of peace of mind, and we're going to get into the details of that soon. So just to give you an overview of what we're going to cover today, I'm going to be talking for a while about real estate investing goals. And then Fatima is going to cover how you can actually access your money today that you might not know about. Okay, so why is it important to start now? So we're going to get more into this, but the basic concept is you got to start now, because really compounding interest and exponential growth are so powerful. And every single year you delay in moving towards your goals, that is potentially could add up to millions of dollars within 10 or 15 years. And so because of the power of compounding interest, this is where being a math nerd can really help you out, is you got to start now, like have an urgency into moving towards your goals. And I just want to talk about this quote from Albert Einstein. Compounding interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And I just think this is such a powerful quote. I love this quote because it is really something that once you wrap your mind around it, it will drive you to start figuring out how to make all these pieces of wealth building fit together for your life in a way that works for you and serves your goals. Okay, so what's the first step? The first step is to assess, get a bird's eye view of where you are now. How old are you? How much money do you earn? How much money do you have in terms of your assets? Do you own a house? Do you have savings? Do you invest money already in stock market and rental properties? And what is it that you are really driving towards, right? So do you have a lot of time? Do you have a lot of money? Do you have little time? Do you have little money? Once you can get a handle on some of these things, as well as the other important question, which is, do you want to be a hands-off investor or a hands-on investor? And as I mentioned before, those two things can actually work really well together. Personally, I am both a hands-on investor and a hands-off investor. And those two, from a tax perspective and reducing your tax liability, that works tremendously well. But you got to think about these things, okay? So we're going to go back to why Fatima and I choose to invest in real estate, choose to invest in commercial real estate. Okay, so, with this slide, we're really looking at, you can do a lot of different things to put your money to work. You can invest in the stock market, you can start a business, you can give it to your investment advisor and just let them deal with it. You can buy a rental property, you can invest in commercial real estate. So why do I like to invest in commercial real estate and real estate? So number one, it's an investment that's backed by a hard asset, right? We talk about this a lot in real estate because unlike stocks, real estate is a hard asset. So even if the economy tanks, you still have a building, a tangible asset that people need. People need to live in houses. People need to, people are going to be going to, there's retail. It's a hard asset that's not just going to drop to zero overnight in the way that the stock market can be very volatile, as we know. Of course, there's good reasons to invest in the stock market and good ways to do that. But the reason I like real estate is because it's tangible and it can continue to produce cash flow in times of a downturn. Number two is control. So with real estate, we have a lot more control over it. We can control who we decide to work with, especially in syndications. We can control the asset itself if we actually buy an investment property. With investing in the stock market, there's a lot less control. You don't necessarily have control over global events that could drastically impact your portfolio. Don't have control over what someone tweets, which might drastically impact your portfolio day to day. Number three, leverage. So with real estate, we have the magic of leverage. We have the magic of being able to get debt on our buildings up to 50% to 80% of the purchase price of any property we can get a mortgage on. So this is very powerful. We're not going to go into the details of it right now, but basically it allows you to supercharge your profits. When you think about buying stock, you're actually just buying $1 worth of stock. Whereas with real estate, when you buy $1 worth of a building, you might actually only have to put down 25 cents for every dollar. And then as the building appreciates, you still only own that 25 cents, or so you still only own 75 cents if you had put down 25 cents. Okay, so that's leverage. Number 4 is tax benefits. So real estate is one of the best places to invest your money. If you're paying a lot of taxes, there's a lot of ways that you can leverage real estate in order to pay less taxes. So this is a complicated issue. We're not going to get into the details at this moment, but just know that it's another way that juices the returns of investing in real estate. And number 5, and I think for me, this is arguably the most important, is just peace of mind, right? Like, I do not like seeing my investment portfolio go down. And I would prefer to sleep well at night and not worry about my retirement. And honestly, I sleep so well with the type of investing that we do in real estate syndications. It really suits my personality to not be kind of monitoring day to day. Like, I see a lot of people, they watch their stock portfolios and they watch them every single day. Did it go up or did it go down? To me, that's just not how I want to live my life. And I also don't want to be subject to the whims of the volatility in the stock market. So for me, I just really prefer that peace of mind. Okay. So active versus passive investing. This is where things might start to get a little bit new for some people. What is active investing? So active investing is when you buy your own properties, like an investment property, or you buy a vacation rental out by the coast and you decide that you want to make that your second home, but you also want to rent it out on Airbnb or VRBO. Some more traditional types of active investing in the real estate space are flipping houses and wholesaling. So this is when you're really hands-on, okay? And although, even if you have a rental property that you own, but you have a property manager that manages it, that's still considered active investing. Why is that? Because you're still liable if the roof needs to be replaced. You still have to pay the mortgage if a tenant moves out. You've got to replace the water heater if it breaks. You might be sued if someone slips and falls on your property. So that is one of the things that differentiates active investing from passive investing. And so what are different forms of passive real estate investing? There's a buzzword, passive income. So how do you actually achieve passive income through real estate investing? So there's a few different ways you can invest in real estate syndications, which is what we're here to talk about today. And a real estate syndication is essentially a group investment. We're going to go into some more of the details of that in just a moment. A lot of people wonder, well, what is that, like a REIT, or is that like Fundrise? And while there are some similarities, there's some absolutely important differences, which is critical for everybody to wrap their minds around. So I'm going to start by giving an example of what a real estate syndication is. So a real estate syndication is a group investment. Let's imagine that me, Suja, I buy a single family home, and then I decide, a few years later, okay, I want to rent out my single family home and buy a new home for myself to live in. So now my first home, I'm renting it out. Okay. And I get experience. I learn how to manage tenants. I learn how to select tenants. And I know how to manage the property and fix things. And, I was able to fund my own buying of my second new house. And then a few years later, I'm like, I really like this, and I want to buy a fourplex. And I save up the money, and I buy a fourplex, but it takes me 5 years. So I buy a fourplex, and then I get pretty good at managing that. Okay. And then I realize, I'm like, wow, I have all these skills. I can actually manage these buildings really well. But what's the next step? Well, I want to buy a bigger building, but I don't have the capital. I can't actually fund the down payment and the construction costs of rehabbing the buildings. So what am I going to do? Well, maybe I'll ask my mom, maybe I'll ask my friends, maybe I'll ask my colleagues, hey, do you guys want to go in on this building with me? And you'll be silent partners. I will be responsible for everything about the deal, including signing on the loan, including finding contractors, including dealing with tenants, including dealing with disposition of the asset when it's time to sell. And I'll manage every single aspect, and I'll send you returns. You'll be owners, but you won't have any responsibilities. And people think that's a pretty good deal, right? Because they know that I'm good at what I do. So that on its base is what a real estate syndication is. Now, the types of real estate syndications that we do are much bigger in scale, sometimes 150 units, 300 units at a time. And there's more passive investors. There's maybe 150 passive investors. But the cool thing is we get to band together and benefit from the expertise of the operators who have developed the skills to effectively and profitably manage an apartment building rehab, an apartment building optimization, taking it from an asset that's kind of maybe struggling or not optimized to something that's running like that's very fine-tuned, a fine-tuned machine that is pumping out cash flow and we can sell it for a big profit. So that's what a real estate syndication is. What's a REIT? Well, a REIT is typically publicly traded, and a REIT is also you're not a direct owner, and so you don't get the tax benefits. And also, it's invested in all different types of assets, so you don't really have control over what goes into the REIT. So those are some critical differences. With a real estate syndication, you're presented a deal and you say, do I like this deal? And then you invest in that deal. And so there's a lot more control. You know who's behind who the operator is, who's managing it. Do you like the team? Do you like the market? With a REIT, there's a lot less control. Okay, so what about Fundrise? Fundrise is, it's kind of in some way similar to real estate syndications, except that you don't necessarily have the same connection. With real estate syndications. You usually have like a pretty strong connection to the sponsorship team, and you get familiar with them, you know them well. You're also a direct owner. With Fundrise, you don't get the tax benefits that you would get, and you're kind of one step removed. So what I say about Fundrise and REITs is that they're great for people who want to kind of dip their toe investing. They don't have a lot of money to invest. Maybe they have $500 or $1,000 to invest, and they want to put it into real estate, hard assets, but they don't quite have the amount of money needed to get into a syndication, which is usually, can I just ask everybody to mute, please? We're getting a little bit of sound. Thank you. So those are some of the key differences, but all of those constitute passive investing. Obviously there's a lot more to say there, but we're going to move on for now. Okay, so we just went over this. Okay, now we're going to talk about the returns, because most people want to start there. What can you expect out of a real estate syndication as far as returns? So typically what we're looking to do in real estate syndications is we're looking to double investors' money in 5 years. Now, of course, that may change from deal to deal, but baseline and current market trends, that's approximately what we're looking to do, what most operators are looking to do. Now, it's up to the people who are vetting the deal, like myself, and investors to determine whether or not they think that this is going to be achievable. But that's basically what we're looking to do. Now, how does that happen? Well, this example is actually on a 3-year time frame, but how that happens is through a combination of cash flow and appreciation. So usually the cash flow will come in years 1, 2, 3, 4, and 5. And usually it can range anywhere from 2% to 12%. And that will depend on the type of deal. Every deal is a little bit different in terms of how it skews between income and growth. And so it's up to the investor to determine what is it that I'm comfortable with. So there's cash flow. You'll get part of your return through cash flow. And then at the end of the whole period, so what we do during the whole period is we take the asset, we manage it, meaning we rehab it, we improve operations, we decrease costs, and we increase income, and we optimize the property. And then we prepare it for sale, right? So we're taking an asset that was maybe underperforming in some ways, and we're turning it into a high-performing asset that we can then sell. And there's a large chunk of equity and appreciation that happens upon sale. So as a passive investor, you get part of the returns as cash flow during the whole period, and you get part as a nice back end, is sometimes what people say it, a back end investment. So I hope that helps give a basic overview, and we can always go more into that, but just the main point is we're usually trying to double money in 5 years. Okay, so just to dive into a couple of things that people are usually thinking about when they're thinking about syndications: growth versus income. So each deal that you look at with a real estate syndication is going to be have some kind of balance between being a growth deal versus being an income deal. So what does that mean? Okay, growth is when more of the returns come at the end of the deal. So you have lower cash flow up front, but you have more returns at the end. An income deal is usually focused on cash flow. For people who are trying to build up streams of cash flow, income may be what they want, but it really depends on where you are in life, how quickly you need to snowball your wealth before you can start really focusing on just pure income. So some questions to ask are you trying to build up cash flow so you can sustain your life? If you are, then you may eventually want to focus on income deals, but you might not want to start there at first because, as we'll see, you need to grow that wealth. You need to grow in an exponential way the equity that you have so that you can have a portfolio that's large enough to kick off the kind of cash flow that you need or want to fund your lifestyle. Okay, another question. Are you trying to save for a purchase or college or a healthy retirement fund? In that case, you're focused more on growth. That doesn't mean you wouldn't want to get cash flow, right? There's reasons to like cash flow, but if you're focused on growth, that's because you're focused on kind of developing this pot of money that you have a plan for. Okay, so now let's talk about some of the basics of a syndication. Who are the key players? So we're going to start with the sponsor. The sponsor is like the pilot. We're going to use an analogy of flying a plane. So the sponsor is also called the operator and is also called the general partner. It's important to kind of wrap your mind around the vocabulary of real estate syndications because otherwise it'll just sound like gobbledygook and you'll feel lost, right? So that's part of what we're doing here is trying to help distill the words that are used so that you can understand. So the sponsor is the team that is responsible for all aspects of the transaction. They're responsible for finding the deal, which means they got to have relationships with brokers. They got to know what's happening in the market. They got to know what they want to buy and at what price they want to buy it. And then they've got to close on the deal, right? They've got to be able to close. So what does that take? Well, in order to get the best properties, you've got to have a proven track record. Brokers have to know who you are, and you've got to be able to say, I can bring, $50 million to the table or whatever it is, and have the broker believe that you will make that happen. So that might not just happen for someone who's just starting out, right? Like it's not going to. You have to build up a track record. So the sponsor gets the deal, and then they've got to execute the business plan. So they've got to operate the property. They've got to manage the contractors to get units turned. They have to fine tune their property operations. So there's a lot that goes into property management and executing a business plan. It really requires strong operations, and that's what the sponsor is responsible for. And then lastly, they've got to dispose of the deal. So they've got to be the ones who decide what's our exit plan, how are we going to exit, when are we going to exit to benefit our investors and ourselves and everybody involved in the deal to the most that we can. So the sponsor is kind of like the pilot in this analogy. Okay, the sponsor is taking us from one place to another. Okay, what about you guys? So y'all are passive investors or silent partners or limited partners. So again, those are all terms that refer to the same role. Passive investors, silent partners, limited partners. So this group is called the passengers. And really the main role of the passengers is to invest equity and then to let the sponsor do their job, collect returns, and then land. Once you land, you get off the plane. There's not really much that you have to do except put your money in. Of course, you have to decide which plane you want to get on, right? And so that's where most of the responsibility with the passive investor comes. And you do have to file taxes every year. With our deals, you'll get a K-1 and you hand that to your accountant or input it into your tax software. And you do have to do that every year. Okay, what about the fund manager? So I, Suja, with Lux Capital, a fund manager. And so my role is like the travel agent. I am helping passive investors decide where to put their money. I'm, of course, putting my money in every deal. I'm creating relationships with the different operators. I'm vetting opportunities. And then I'm providing my investors with a host of options. So my goal is like the travel agent. And also the other thing that we do is we get deals, right? Travel agents can get good deals. And so we are able to do that with our operators. With the power of group investing, we can negotiate preferential terms and treatment, which allow me to be compensated and also allow my potentially passive investors to get usually approximately the same returns, if not even better returns potentially with the power of group investing. So those are some of the key players to understand as you're getting started in this space. Okay, so one of the common questions that we get is, isn't this too good to be true? I mean, I know it sounds silly maybe, but it is a very common question. Like, it sounds like a scheme or something that's not actually going to work. But real estate syndications really are that profitable. Now, why are they? Well, we like to say there are 5 ways that you make money in real estate. So and let's talk about that, because that really plays into what makes them so profitable. So appreciation is the first way. We know most people kind of understand that you buy real estate and then it's going to go up in value over time. So we kind of break that up into 2 different types of appreciation. There's market appreciation and there's forced appreciation. So market appreciation is when the property values just go up over time. Most people understand that. Forced appreciation is when we improve a property to improve its value. So we rehab it, we improve operations, and that's called forced appreciation. The second way that you make money in real estate syndications is cash flow. So cash flow is the money that you collect through rents. And it's actually pretty cool. If you've been investing from stocks your whole life, the first time you invest in a real estate syndication, in maybe 1 or 3 months, you're going to get a deposit in your bank account, most likely. And that's going to be hard cash that you can use to do whatever you want with, right? And so that's one of the benefits. And one of the ways that we make money in real estate. Number 3 is loan pay down. So we have tenants in real estate and the tenants pay rent, and through their rent payments, they're actually paying down a portion of our mortgage, right? So over time, we have less and less that we owe on the property. Number 4 is tax benefits. Again, lots of tax benefits for real estate investors, which we're not going to go into the details right now, but it is a really key part. That's something that as you become a savvier investor, you'll start to focus more and more on. And number 5 is inflation hedge. So because rents are going to go up with inflation, that means that the value of our assets will hold, right? So this is really important because especially right now, it's December 2022, and we're in an inflationary time. And so it's important to know that if you park your money in commercial cash flowing real estate, it's going to have a hedge against inflation. Okay, now we're going to take a minute to just look at some math and understand appreciation in commercial real estate. Because in order to double our money in 5 years, we have to force appreciation and make sure that it and make the value of the property grow quite a lot. So how does that actually work? Well, let's look at an example. Okay, so let's say you have a 10-unit property and you increase the rent on each unit by $1 per month. So $1 per month times 10 units is $10 per month. $10 per month is $120 per year. Now we're going to talk about cap rates just briefly. So a cap rate is how commercial real estate is valued. Commercial real estate is valued like a business. So investors will buy an income stream. So cap rates kind of vary depending on the market and how hot a market is and how volatile the market is at the time. But a 5% cap rate is a fairly standard cap rate. So let's just go with that. So we're going to apply a 5% cap rate to this increase in net operating income. Net operating income is simply income minus expenses, and it's a very important metric in commercial real estate. So $120 divided by 0.05 equals $2,400. Now that doesn't sound like that much, right? But you got to remember, we only increased the rent by $1 per unit. So what if we increase the rent by $10 per unit? Well, then the increase in value of the property is $24,000. That's getting sounding more interesting. Depends on how much money you put into the property in the first place. But what if you input $100 increase in rents, which is not a huge increase, right? It's not that large of an increase. Well, all of a sudden, the profits, the increase in the value of the property that you've created is now $240,000. Now, that's real money. That's really a lot of money. And when you think about it, if that just comes from $100 increase over 10 units, very powerful. So that is one of the reasons why demonstrates how real estate, investing in commercial real estate is so profitable. Okay, so what are the requirements of investing in syndications? Well, there are requirements. You can't just have anybody invest in syndications. So one is that you must either be a sophisticated investor or an accredited investor, and only some deals are open to sophisticated investors. A lot of deals are only open to accredited investors. So what is a sophisticated investor? A sophisticated investor is someone who's capable of making investment decisions for themselves. Usually they have someone who advises them and helps them make these decisions, but they have some financial acumen. There's not a lot of specifics with this particular category. And, again, this is for educational purposes only. So make sure you do your own research whenever you're verifying anything that we talk about in this presentation. Okay, what about an accredited investor? So to qualify as an accredited investor, you've got to pass one of two tests, the net worth test and the income test. So to pass the net worth test, you've got to have $1 million or more, excluding your primary residence, between yourself and your spouse if you're married. So a total of $1 million, either as an individual or as a married couple. So that's one test you could pass. And including in that, net worth, you can have your retirement accounts, you can have other rental properties that you can own, you can have all your bank accounts, even your cars can count towards that. Number 3, income test, the second test you can pass is the income test. So the income test, to pass it, you have to have either $200,000 in income if you're single per year, or you have to have $300,000 in income annually as a married couple. So there's some nuances to this that we won't dive into now, but that's the basic requirements for investing in syndications. Okay, now I want to talk about what investing $50,000 a year can do for your life, right? Because it's so important when you're doing anything that you know why you're doing it and where you're headed and how to get there. Okay, so we've talked about, creating goals and figuring out what your destination is. So do you want to create passive income that can fund your lifestyle? Or do you want to pay for your kids' college? Do you want to have a certain amount of money saved so that you can feel secure retiring? So I created this example. What can investing $50,000 a year do for you? And these are my numbers. Some of the assumptions that I made are that we're achieving a 15% return, which is actually less than the doubling of the money that I had previously mentioned. But so I'm assuming a 15% return, and I'm assuming a 25% tax rate. So I had a friend who, she told me that she wanted to retire at the age of 50 and become a monk and just meditate and not worry about anything else. And she's a very shrewd businesswoman. She's very talented. She's so hardworking. She's amazing at what she does, but she lacks the investor mindset. And so she didn't really have any idea of how to actually achieve that, right? And so what I did with her is I said, okay, well, what are your monthly expenses going to be? And we settled on the number 6,000, not accounting for inflation, but we settled on the number 6,000 as a starting point. And she wants $6,000 of income per year in order to fund her lifestyle by the time she's 50. So what would she need in order to achieve that $6,000? Well, it depends on how much money that you want to, how comfortable you are with where your money's going to be. But it was in the neighborhood of $2 or $3 million. Okay. So she needed about $2 or $3 million in order to achieve this. So how is she going to get there? Well, if you invest $50,000 every year for 5 years, at the end of the 5 years, you'll have about $327,000 in terms of a pot of money. Okay. And then what are you going to do with that pot of money? Well, we'll talk about it in a minute. But this is where we start to understand the power of compounding interest, right? So this is why it's so important to get started now, is because in year 7, she'll have $520,000. That's pretty good, but it gets a lot better, right? So by year 10, it'll be almost $1 million. By year 13, 1.6 million. Year 15, 2.2. So it starts increasing much more quickly, right? The nature of exponential growth is that it's kind of not that exciting at first. But then once you start to hit 10, 15, about 15 to 20 years, things start to get really exciting. And so that's why it's so critical to start right now. So by year 18, she would have $3.3 million. In order to achieve her goals, she actually would need about 15 years in order to retire with the amount of money that she needs to create her cash flow. And we base that on a 4% return, because that's kind of a return that people will use if they really just want to set it and forget it. So if she was going to withdraw 4% from her portfolio every year, then it would take her 15 years to achieve her goal. The thing is that she's 37 right now, right? So in order to achieve her goals, she would actually have to retire at around year 53 or so in order to actually achieve her goals. And that's just a matter of three years, right? Like if she waits 2 more years until she's 39, then she won't be able to retire until she's 55, right? And so if your timeline, if your goal is to have something, accomplish something by the time you're 50 or 55, it's really important to start to work backwards and make sure you're on track. And if not, figure out how to actually get on track. Okay. Now, again, it's not actually about just having a pile of cash, right? Like just having a pile of cash doesn't actually do anything for your life if you don't really know how it's going to help your life. So will it replace your income? Will it create a secure retirement? And, we're not going to talk about what to do with that pile of money right now, but that is part of the conversation. It's going to determine what your particular plan is. Do you want to be like my friend and just take 4% out of your money at that point? Or do you want to keep growing it, right? And how is that actually going to enhance your life? So all of these things kind of start to work together and help you figure out how you can use real estate investing, which can grow so much faster than a lot of different investing opportunities, in a stable way, right? So that's the other reason. It's like risk adjusted returns. I like investing in real estate syndications because we get very, very strong returns on a risk adjusted basis. You can make a lot more money in, the stock market or crypto much more quickly, right? But you can also lose it a lot more quickly. And so that's why I like real estate syndications, is because I like to know that my wealth is growing steadily and exponentially. Okay, so how do you get started? I'm going to now pass it over to Fatima, because a lot of people want to get started with this, but they don't really know how to make the most of their current financial situation. So Fatima, happy to pass it back over to you, and let me know when you want to go to the next slide.
Okay, thank you so much, Suja. I'm super excited about this opportunity for myself and for my friends and family and clients. Again, my name is Fatima Carter with Arbor Financial Group. I apologize for my voice. So I haven't been an investor, like I said, since 2005. And from my, one first home purchase, I was able to take that equity and then build my generational wealth in real estate by purchasing other properties and being a landlord and Airbnb. I did this through refi, cash out options, HELOCs, home equity line of credits, and as well as 401k loans. As you can see in that picture there, I have a man inspecting the home that is sitting on a pile of cash. Next slide, please. Okay, so I know there's a lot of words on here, so I'm just gonna go through it pretty quickly. These are super important questions to ask yourself. How is your equity working for you currently in your home? A lot of people don't even know, or they don't really care or want to touch the equity, just based on culture and beliefs or fear. What is your current ROI, rate of return on your investment? And there's the calculation. Some people can't even think about calculating that. So how did Fatima personally do with her own decision of taking money out of her own primary residence to purchase other homes and build that wealth? just really quickly, and so back in 2005, I had purchased 5 homes in Texas and then in Arizona. I would build and flip in Arizona, and then I purchased our primary in Austin, Texas, another rental in Austin, Texas, and 3 rentals in Dallas, Texas. And then we lived there for 2 years. We had a baby. Our family was on the West Coast, so we ended up selling the primary and one of the rentals in Austin. Kept the 3 rentals in Dallas. This was 2007 to 2009, and of course, as you all know, what happened in 2009? There was the mortgage crisis. But I kept those 3 homes in Dallas. I didn't feel the need to sell them. The tenants were paying their rent. Everybody needs a home, a roof over the head, and that's going to usually is the first thing that they pay. So those, even though they were half of what I purchased them for, I purchased them in 2005, 2009, they were 50% of what I purchased them for. I didn't let fear take over. I knew that this was a long-term investment. And now they're almost paid off, and the rent has increased a lot, and that's just going to be extra income in my pocket that I can use to supplement, the kids' tuition, or put into an other types of investments, dollar cost averaging, or to put into, save for another opportunity in real estate. So then when we moved to Oregon, we purchased our home in West Lynn, and it was the bottom of the market out here. 2012, bought it for $382, and in 2019, I've been going to Pacific City. I love Pacific City. Fell in love with it. We're walking the beach. I'm like, oh, I wish we could have a home here. Why don't we just go home shopping and just for fun? Found a home. It was $419, and we got it. We took. I did a cash out refinance on our home. We had it appraised, and we were so delighted to see that the value was appraised at $715 on the house. So we were able to take out the 20% for the down payment and extra money for the rehab, because the home definitely needed to be updated. Like Suja does, she, gets these properties and she updates them, because you want to get the most out of your investment. You're able to increase the Airbnb rental prices. So definitely see a difference staying in Airbnbs when they're not pretty or new, or have that new smell, or new furniture, paint, and they don't take care of the property as well as if it is brand new looking or feeling. So I knew that, and we did the remodel. So I took out the 20%, and then I think it was about $48,000 for the remodel, and I have been able to rent it no problem, even though I'm one of the higher rents in the area. So then we did another refinance, because we wanted to move into a home that had more of a yard. Kept that home and rented it out, and then took out another 20% to put down onto our home now. And did a rehab, took out $200,000 for the rehab on this home. And now it got appraised, at the 1.35 million. And then my home, the other previous home, is worth $1 million. So, I mean, that's pretty amazing how real estate, what it can do for you and your family. And my why is my mom. She was a single mom, 3 kids. I'm a firstborn generation here. She came and was able to work odd jobs, but she was able to buy a home in Los Angeles back in the 60s, 70s for like, I don't know, 30 to 60, I forgot. But she was able to sell it for like $350 back in 1989. She bought 2 more homes, built a Mexican restaurant, and a flooring store just from that one purchase, that home purchase. So I saw that growing up, and I was like, wow, that's a single mom, no college education, was able to build this wealth for herself. And now she's retired, and she gets that rental income from her homes. So I guess the question you can ask yourself regarding Suja's proposal here is, what are you waiting for from Gwen Stefani, one of my favorite singers, and no doubt, of course, my favorite band. So next slide, please. Okay, so option 1, refi cash out. So as you all know, the rates, have gone up since 2020. Expert economists are stating that they are to go back down again 2023. They can, only be, and we can talk about this later if you want to schedule an appointment with me. I can go over presentations based on the past 20 years history. There's ebbs and flows, ups and downs, and it's just it's cyclical. But let's just take a look at this option for now. And then, so cash out refinance allows up to 80%. So regular 30-year, 15, 20, 80% loan to value is the cap. And I'll go over into a quick calculation example. The good thing about a refi, it's a fixed rate. It doesn't fluctuate. The payment does not fluctuate. And talk to your tax advisor, because I'm not a tax advisor, but it could be, the mortgage interest could be tax deductible. Next slide, please. Okay, so an example, let's pretend your home is worth $850 now. Your current mortgage balance is $481, and your current interest rate, because you were able to refinance in 2020, 2021, is 3.5%. Your principal and interest payments is $22,161. If you were to do a refi cash out as of today, based on a 780, 760 FICO score, the new loan amount would be the 41 plus your 50 cash out, even though you only need 35 for this investment, right, Suja? But you could put more. I think the minimum is 35. And go back, sorry. And then the closing costs of 4,654. So the new loan amount would be 535,963. The rate as of last night when I pulled it was about 5.99% for refinance cash out. So remember, whenever there's a cash out, there's always a little hit on the rate. So almost like a point hit on the rates. But so the new payment would be 2,910. So yes, your payment does go up. Oh, I miscalculated that. Sorry, I have to fix that. So the total investment now is 50,000. Rate of return, like she mentioned, was 20 to 22%. Your benefit, she went over those numbers. So yes, the amount is small right now because the rates are a little bit higher. So once the rates drop, I highly recommend having me recalculate everything. Don't forget though, even though it's $168 a month, you are earning the equity being built into the homes that she is refurbishing, and you're getting that income as well. And then when they sell it, you'll get part of the equity. So, and then just a side note, economic forecast rates, a lot of people are saying, expert economists are saying they're going to go back down to 3.5% to 5.5%. We don't know. And then those are example payments. Once they do go back down, for example, 3.5%, your payment will be $21.59, even with the increased loan. And then if it goes down to 4.5%, it'll be $24.64. Next slide, please.
And this is Fatima, just really quick. I think just to stack on top of what Fatima's saying with the cash out refis, is that a lot of people build their wealth through their homes, right? That's their main, oftentimes, and you might have a retirement account, but oftentimes people build their wealth through their homes. The key is to actually getting your wealth to snowball. And, this is just kind of reflecting on what Fatima's just said. The key to getting your wealth to snowball is to leverage the equity that you have in order to actually snowball your wealth faster, right? This is how you can start making faster progress towards your goals. And of course, there's some considerations. You want to make sure you can cover the loan payments, and you don't necessarily want to be overextended, but you want to know all your options, right? And you want to know how to put your equity to work. So, and Fatima, obviously, as a loan officer with a lot of different resources, is able to help you figure out that picture. Okay, Fatima, back to you.
Yeah, exactly. Because, a lot of people have their savings accounts. They think of savings as a regular savings account in a bank or an investment portfolio. But real estate, you should see your home as a savings account as well. So even though your payments might have jumped up a little bit in the short term, just see it as you putting money into your savings account. I promise it's going to earn a lot more interest than it's sitting in your bank savings account. It's not even beating inflation rate right now. You're losing money if it's sitting in your bank account. So hopefully that all makes sense there. It's a kind of different way to look at it. Here on the county that we're talking about, you'll see the history of the appreciation, and then the forecasts based on data from the Federal Housing Finance Agency, CoreLogic. So the 5-year is 23.78%, kind of what she mentioned earlier. And so if you were to buy, if you were to buy a home, at 283, your gain would have been 67,360. Again, the numbers are going to differ with her investment, but the good thing about her is, as an investor myself, I had to do the rehab, right? I had to find all of the contractors. I had to pick out the paint, the furniture, that takes time and energy from my job of being a mortgage originator and going out and getting more business and taking care of my clients. So when I heard about this, I was like, oh my gosh, this is a no-brainer because I don't have to worry about all that, driving back and forth to Pacific City late at night, making sure everything's good. And then I run my Airbnb. So, I'm making sure that the clients have their check-in information, making sure the cleaners are cleaning the house in time. With Suja, I don't have to worry about any of that stuff. She takes care of everything. To me, it's a no-brainer. But anyway, so here's the average of the appreciation, the indexes in the United States. So you can see, South Carolina is in the green, is 20% above national average, whereas, the West now is falling behind a little bit. So you can see that migration, people are wanting to go visit, go move, and over to those areas there. You want to follow the money. Okay, option number 2. This might be a good, and what I forgot to mention as well, it depends on how much money you want to take out on your home. So that example I had of 850, technically they could have gone up to 200,000. The more that you take out, then it makes more sense to do a refi cash out if you're going to take a higher rate. It doesn't make as much sense to do the refi cash out option right now with the higher rate if you're only taking 50,000. So that's why I'm thinking maybe the home equity line of credit might be a better option at this time. And then once rates drop again, then you can refinance both your current first and the HELOC. So what is a HELOC? It's a home equity line of credit. The minimum line size for our HELOCs is 50,000 and the max is 500. It could be on your primary residence, condos, and second homes, which is awesome because for a while there, the second homes were not allowed. So CLTV, combined loan to value, meaning your first and the HELOC can only go to 89.99%. And I do offer, there are other company HELOCs that might go a little bit higher than that. We could talk about that later in a meeting for your primary. And then the 80% CLTV for second homes. Your minimum FICO is only 680, which is one of the lower FICO scores I've seen for your primary residence, and 700 for second homes, because HELOCs are generally a little bit more conservative on their minimum FICO scores. Interest only payments, which is nice, with the 10-year draw, so meaning that interest only for 10 years, and then after that it's amortized over a 20-year period. Sorry, the index is prime rate of 7%. That's what it is today, 7%. And then it's 7% plus your margin. So your margin's fixed, but the prime rate, as you know, would fluctuate based on the market. And all of that is based on your FICO, CLTV, owner-occupied, non-owner occupied, and the states. So it's a variable rate, fluctuates, but the margin's fixed. Next slide, please. Okay, so this is an example as of last week. You can see here the loan amount, the credit score, how it varies. So if you had a 6,760 and up, it would be prime plus 1.24% for 80%, or prime plus 2.24% when you go higher up to 89.99%. And then you'll see some adjustments there for California and New York. And then the second home, you add the 0.25% to the margin. And then next slide. So here's an example. 50,000 at 8.124%. That's the 760 at 80% loan to value, combined loan to value. The interest only payment would be 338. And then again, based on a 20% average annual return on that 50,000, you would gain $833 a month. Your net benefit would be $495 a month. So that seems better than the 168, with the refi cash out. And then don't forget, based on what Suja had in her email, you have the benefit of cash on cash during the hold period and participation in the upside of the sale proceeds. So super excited about that little note right there.
Yeah, totally. And just to add on to that, so I mean, this would be the net benefit that Fatima was talking about would be kind of from a global perspective. Obviously, you would want to make sure that you would have this extra 338 per month to pay. And of course, since it's interest only, that would probably work out, but it's something to kind of make sure you understand. And again, the HELOC is going to go up and down with rates. So most people are projecting that rates are going to start to go down in 2023, as Fatima mentioned. All right.
Okay.
Back to you.
Yes, and I'm happy to do budget with you as well. That's what I usually do with my clients. We go over your budget, go over your finances. What do you feel comfortable paying? And see what we can cut out during the month. How many Starbucks do you go visit every, weekly, and how much does that could you save just on Starbucks? So option number 3, 401k loan hardship loan. Okay, 401k loan and or hardship withdrawal. What are those? So 401k loan are usually for primary purchases or general purposes only. Depending on your 401k administrator, you want to ask them about their guidelines. Typically, you can borrow up to 60%. Everyone's different on their guidelines of your vested balance. So if you already have a 401k loan on there, that kind of lowers your how much you can take out. They have longer repayment periods, which I like because your payment is lower when you pay yourself back. So 10, 15, 20, or up to 30 years on a primary purchase. Pay yourself back around 5% is what I've seen. And it's just taken from your paycheck. Again, check with your 401k, and they usually ask for purchase agreement, closing cost worksheet from a lender. So we probably want to do the general purpose reasons for this opportunity here because it's not a primary residence. So you would do your general purpose. It's a 5-year repayment plan usually. And so, you would, when you go on your 401k website, you should be able to go to withdraw or 401k loans, and it will calculate for you exactly how much they would take out of your paycheck to pay yourself back. Remember, you're paying yourself back. The 401k hardship withdrawal, that is taxed as ordinary income. There's usually 10% early withdrawal penalty, and there may be limits again on how much you can take out. But again, these are just another option for you. Next slide.
Just to add on to that, Fatima, so also in the 401k category is self-directed IRAs. So if you have a 401k from a previous employer, you can usually roll that over into not just an IRA, but a self-directed IRA. And you need a custodian in order to do that. But then you can invest in real estate syndications with a self-directed IRA. So that's just another related topic on the 401k front.
Oh, can you elaborate on that though? Just for my own purposes.
Oh yeah, sure. So a lot of times, if you want to invest your retirement funds, you can do this 401k loan. So that's something you could do with your current employer, right? But if you happen to have had a previous job with a different employer and you have retirement funds that were either left with that employer or maybe you rolled them over into an IRA, then you can actually take those IRA funds and roll them over into a self-directed IRA using a custodian. And then you can invest in real estate syndications and other alternative investments with the self-directed IRA. And there's a lot of rules about that in terms of what you can invest in and what you can't. But once you kind of get a handle on it, there's really a ton of options. And it's a way for people to take control of their retirement so that they don't just have to be in regular market assets. Like they don't just have to be in stocks and bonds and mutual funds with their retirement. So that's the reason for the self-directed IRA. And we can definitely, that's something you're interested in, I have partners that I work with that can help you set that up. Some of them have a higher touch customer service. So they're a little bit, more of a white glove experience. And so they're a little bit more expensive. But if you know what you're doing and you're kind of savvy in this space, you can go with a lower customer service option and just more the services online. So that's called a self-directed IRA. And if you want to explore that, set up a meeting with me, Suja, after, and we'll talk about it.
That is so cool. Yeah, I learn something new every day. And I highly recommend reading the book, The Millionaire Next Door, because he talks about investing in what type of CPAs, financial advisors, the people that are taking care of your finances. You don't want to go cheap on them. because with that you get what you pay for. So super important to realize the benefit of having a white glove experience and paying that little extra premium for that.
Yeah, for sure. All right. Well, I think that is the end of our slides. So now we can go to Q&A, and would love to hear any questions that, I mean, we should have told you guys to put your questions in, but does anybody have any questions to start us off with? I'm actually going to just go ahead and pause the recording. So thank you for coming. I'm just going to stop the recording and we can go into Q&A.